Harvard's #1 investment right now isn't stocks, it isn't real estate, it's Bitcoin. And when I saw that, I had to go deeper, because if a 400-year-old institution is making that their top holding, something has fundamentally shifted. So I went through the 13F filings. These are the legal documents where the biggest investors on the planet have to show their cards every quarter. And I found 3 very clear themes that keep showing up across almost every major portfolio. I'm going to break all 3 down today. And more importantly, I'll tell you what you can actually do with this information as a regular person. So leave a like, subscribe, and let's get into it. Before we get into the portfolios, there's one thing you need to know, and most videos skip this entirely, which is a mistake. These 13F filings are released 45 days after the end of the quarter. That means by the time you're watching this, the data could be 4 to 5 months old. Think of it like getting the answers to a test, except it's last semester's test. There's also a cost basis problem. Warren Buffett bought Coca-Cola in 1988 for pennies compared to today's price. His position is up thousands of %. He's not buying Coke at today's prices. He's just holding something he bought decades ago. Seeing it in his portfolio tells you about his history, not necessarily his conviction right now. And then their scale. When a billionaire takes a small position, it might be $200 million. That doesn't translate to us. So here's how to actually use this information. Don't copy trades. Look for themes. What sectors keep showing up across multiple legendary investors at the same time? That's the real signal. Keep that in mind as we go through this. Section 2. What the portfolios are showing us. But before that, if you like more content like this, make sure to hit that subscribe button so you don't miss out on future videos like this. And I hope you enjoy the rest of this video. Here's a quick look at some of the biggest names. Bill Ackman is heavily concentrated in Brookfield, Uber, Google, and Meta. Very few positions, very high conviction. Warren Buffett is sitting in Apple, American Express, Coca-Cola, and Bank of America. Classic quality businesses with enormous moats. And here's something worth noting. Berkshire Hathaway's single largest holding right now isn't a stock, it's cash. Over $330 billion of it. That tells you a lot about how Buffett sees the current market. Chris Hohn, who runs TCI Fund and manages about $75 billion, owns basically 5 stocks: GE, Visa, Microsoft, Moody's, and S&P Global. That's extreme concentration on businesses that are almost impossible to compete with. Ask yourself, is it easier to start a business that competes with Visa or your local coffee shop? That's the logic. And then Harvard. Their top holding is IBIT, BlackRock's Bitcoin ETF. They're also in Google, Gold, Nvidia, and Taiwan Semiconductor. Not the portfolio you'd picture from an Ivy League endowment. Now, across all of these, 3 big themes keep emerging. Let's go one by one. Theme 1, Bitcoin is now institutional. This is the one that changes the narrative permanently. Bitcoin isn't just something retail investors are buying anymore. The institutions have arrived, and they're arriving fast. Harvard's endowment increased its Bitcoin ETF position by 257%, reaching $441 million. Morgan Stanley launched its own spot Bitcoin ETF in April of 2026, the first major U.S. bank to ever do that, and it pulled in over $100 million in its first week. Goldman Sachs filed for a Bitcoin Premium Income ETF, and across the entire market, Bitcoin ETFs saw $18.7 billion in inflows in just the first quarter of 2026. That is not retail money. That is institutions making strategic allocations. Here's the simple way to think about what changed. Bitcoin used to be the thing your uncle bought at Thanksgiving, and everyone rolled their eyes. Now, Morgan Stanley has 16,000 financial advisors recommending it to wealth management clients. That's a completely different world. What drove that shift? 3 things. Regulatory clarity with the approval of spot ETFs, Bitcoin can now be held inside 401k retirement plans, and growing fears about currency debasement, meaning as global debt keeps rising, investors want assets that can't just be printed into existence. Now, the honest caveat, Bitcoin dropped 44% during one correction, even while institutions were actively buying. Volatility hasn't disappeared. If you want exposure, keep it small, 1 to 5% of a portfolio max. The theme is real. The risk is too. Theme 2, AI infrastructure is the actual play. Everyone already knows Nvidia, Microsoft, and Google are betting everything on AI. But the investors looking for real outsized returns aren't buying what's already priced in. They're buying what powers AI behind the scenes. Think about the gold rush. The people who consistently made money weren't always the miners. It was the ones selling the pickaxes, the shovels, the jeans. That's called the picks and shovels strategy. And it's exactly what the most interesting portfolio in this video is built around. His name is Leopold Aschenbrenner. He's 24 years old, a former OpenAI researcher, and he wrote a famous 165-page essay predicting an AI explosion that most people aren't even close to prepared for. His fund grew from $225 million to $5.5 billion in equity exposure. And here's the part that surprises people. He owns 0 Nvidia, 0 Microsoft, 0 Google, 0 Amazon. None of the headline names. Instead, his top positions as of Q1 2026 are Bloom Energy at 16% of his portfolio, a company that makes fuel cell systems that power data centers completely off the grid, up over 150% this year. Lumentum, at 8.7%, makes laser and photonic equipment that speeds up AI data transfer, up 143% this year. CoreWeave, at 7.9%, essentially the landlord of GPU computing, and he's also in former Bitcoin mining companies like Core Scientific and Cipher Mining, because those facilities already have massive power infrastructure that's being converted into AI compute hubs. The core insight here is simple but underappreciated. AI needs enormous amounts of electricity. The U.S. power grid was not built for this. Companies that can generate and reliably deliver electricity to data centers at scale are sitting on something very valuable. It's less glamorous than owning Nvidia, but potentially more overlooked, and that's where the opportunity lives. This is the more speculative theme of the three. These are smaller, more volatile companies. Understand the thesis, position small, and don't bet anything you can't afford to lose. Theme 3, hard assets as financial insurance. The third theme is the one that cuts across almost every major institutional portfolio, and it comes down to one idea. Smart money is buying things that can't be printed. Here's why. U.S. national debt is over $36 trillion. Inflation has been sticky. Geopolitically, countries are diversifying away from U.S. dollar reserves. In that environment, institutions are moving into assets that hold value regardless of what central banks decide to do. First is gold, and this is purely institutional, not retail hype. Gold hit an all-time high of $5,595 per ounce in January 2026. Global gold ETFs saw $19 billion in inflows that same month, a record. JP Morgan's price target is $5,000 per ounce by the end of 2026. Goldman Sachs is at $5,400. This is sovereign wealth funds and pension funds building strategic reserves, not people panic buying coins. The easiest way to access this as a regular investor is through ETFs like GLD or IAU. Second is copper and infrastructure metals. Every AI data center requires massive amounts of copper for wiring and cooling. Every electric vehicle uses 4 times the copper of a traditional car. And the commodities market is tiny compared to equities, which means even moderate institutional flows can move prices significantly. Third is real estate, actual physical property. Land can't be printed. Rents adjust with inflation over time. This doesn't mean speculative flipping. It means income-producing assets that hold real-world value. If direct property ownership isn't accessible, REIT ETFs like VNQ give you exposure without needing to buy a building. What this means for you. Here's the thing. You are not a billionaire, and that's actually an advantage in some ways. Billionaires can afford to be wrong on a 50% position drop. You can't, which means your superpower is something they don't have: time in the market, consistent contributions, and low-cost diversification. The practical takeaway is straightforward. Keep your core in a broad index fund like VOO, Even Buffett has said this is the right move for most people. If you believe in a Bitcoin institutional thesis, a small allocation to IBIT keeps it simple and regulated. For AI infrastructure exposure without the single stock risk, look at ETFs that cover energy or tech infrastructure broadly. And for hard assets, GLD for gold and a REIT ETF for real estate give you the theme without the complexity. The biggest investors in the world aren't just throwing darts. You don't need $5 billion to understand that playbook. You just needed this video. If you found this video helpful, make sure to check out this one too. I think it'll really help you out.